Welcome to the Top M&A Entrepreneurs. Today, my guest is Vincent or Vin Cardillo. Vin is the CEO of a company called Meva Dental Advisors. He has been doing dental acquisitions, advising since 1990s when he was in the 20s. Is that correct?
Yep, 1996 or so. Thanks, John. Appreciate it.
Yeah. Well, thanks very much for joining me. I got to tell you, you and I reached out to you quite some time ago, and it took a little while to get you scheduled on this. So really appreciate that. So you started Dynamic. What was the first name of the company that you started?
Yeah, so in the 90s, the first one was called Northeast Dental. So I had started with one office, and that was a fresh start, which we call kind of a de novo. And then I purchased two, and then I did another de novo, and I purchased one more, and then did another de novo, all in my 20s.
All in your 20s. Now, how did those opportunities come to you? Were you looking for them, or did somebody just come to you and say, hey, man, I don't like doing this. I can't make it work. I can't make money. What did that look like? And how are you open to that opportunity in the 20s? Because some people don't see that until your 50s or 60s. Yeah.
Yeah. So I had opened up a dental practice after getting my MBA with the dentist. So I did it with a dentist, and we opened up the practice. And then, our goal was to grow, and we opened up another one. And then there was a company that was private equity backed that failed, and they went bankrupt. So they had these practices that were still going, but they had to divest of them. So, we looked at them and did our diligence, and were able to buy them at a very, advantageous price. I mean, cheaper than it would cost us to build it from scratch.
So they had so the private equity company went bankrupt, and there's these dental practices in there that were looking for a home, and they were trying to unload them. Who did you buy those from? The bank and receivership, or the private equity?
Through the management team that was still there.
Oh, okay.
So the management team from the organization was still there, and they were divesting.
Yeah. What kind of deal stack was that? Was that, hey, take us over, or we're looking for 10 million, or what did that look like?
Yeah, I mean, obviously they wanted a whole lot more, but at the end of the day, the offer was, so if I'm thinking about it correctly, probably 30 cents on what they were looking for.
Yeah.
And, they said no and walked away. And then they came back a couple months later, and then they said yes to 20 cents.
Couldn't find any other buyers. They came back to you.
Exactly.
Yeah. Did you have to raise any money to purchase that, or was it?
No, you know what? I had raised some local angel investor money prior to that. So I had some cash in the tillers, plus I had some bank lines, if you would.
So this was in your business plan from MBA: grow and acquire fast, and then sell to a PE firm.
Right. But I ended up selling to a larger dental group. This is my first one.
That's your first one.
Yeah.
So the next one was Dynamic Dental Partners.
Right. Yeah. So that was we started that in 2011 with two dentist partners that I had known for years, and they had already done the same thing. They had a group, and they sold to a large player right around the same time I did, different ones. They're fast forward 5 years, their non-competes were up. They wanted to get back into business, and I wasn't doing anything at the time. So I said, yeah, well, let's do this. So I moved to Florida in January 11. We started with 3 offices, and in 28 months, we had 31.
Yeah. And that's Alex Gianni, right? Your partner, and you were CEO and founder of that. What did that partnership look like as far as the cap table? I mean, it was 50-50, or what was it? Just kind of minority interest? Yeah.
So I was the COO. So I basically managed and rolled up the operations for that then to be sellable, if you would.
Yeah.
And, you know, our partnerships, me and the two docs and another guy, we were pretty much even partners in it. And then as we brought on these other practices, this was coming out of the, you know, the last recession, if you would. So there was a lot of practices in Florida and in Arizona that had, you know, made a large investment in their practice. And, you know, there was a big downturn and they couldn't handle it. So we started doing a lot of management agreements that turned into acquisitions that said, hey, look, we're managing you, but we've got the right to potentially buy you in the future. And then we also brought in other people towards the end that had a few practices to roll them all in.
Interesting. So you were just at that point, you go, let's go as fast as possible to find, was it distressed, financially distressed, not business wise distressed? I mean, you're in Arizona. I'm in Arizona, by the way. I'm in the Tucson, Arizona, not the,
Phoenix area. Yeah. So, I mean, look, these were good practices that just had too much debt. So they just need to have you know, restructure their debt table, really, or the cap table on however we wanted to manage it. So we were able to do that and in an orderly fashion where we were able to bring these practices together, show that they could be positive results partnering with us. And we pulled it off.
Yeah. And you were
number 14 on the Inc. 500 list that year.
Yeah, I saw that. It's pretty amazing. When you renegotiate that debt, recapitalized, when did you start the relationship with Huron Capital?
After. So we already had to have deals completed or deals in an LOI or some type of commitment. So we could present them with, you know, the whole deck, the whole model, the whole presentation saying, hey, look, here's the practices we acquired, you know, practice number 1 28 months ago. Here's what it did. We acquired practice number 2. And, you know, 3 months later, here's its success, you know, practice 4, 5, and 6 on month 4. And here's, you know, the story, right? So we had to have a good story around, you know, what we're doing. It's just not slapping together saying, you know, here you go.
Yeah. I'm going back to that kind of taking on too much debt. You had to get some more debt, renegotiate it to a lower, you know, monthly price. What kind of company took that on? Was it a bank or was it an institutional investor? Or?
Yeah. So in the end, how it came down, we had a number of practices that we owned outright, maybe, I don't know, 7 of them or 8 of them. Then we had management agreements with another 10 or 12 that was basically like, look, here, we're managing. However, you know, if we have an event in the future, you're committing to sell at this multiple, right?
Yeah.
And then we had at the end a partner that had like 10 locations that was going to come in. So we basically we didn't really have to get much debt except for the 6 or 7 or 8 that we owned. We were packaging this all together.
Oh, okay. So some kind of agreement between those just to, you know, right. Future multiple.
We had a management contract saying, hey, look, we're doing your back office. We're doing all your accounting. We're doing ops for you. So we brought in our back house for a fee, right? And that allowed us to show the success and to bring all of the financials under one umbrella, operations under one umbrella. And actually back then, we actually converted those practices to a centralized dental practice management software, so the data could be centralized.
Yeah. And
so we had all that lined up, even though we didn't own all those practices. They were under agreement in a management agreement with an option to buy them. That's basically what we did.
Yeah. So if you only own one dental practice right now, and I'm sure you advise a lot of people on this, it's a what multiple? A sales or EBITDA? Or
of EBITDA.
EBITDA. And then what's that look like? 1, 2, 5?
Yeah, I mean, I mean, for one practice, it's 3 to 5.
3 to 5. And
Yeah.
and what's the threshold to start moving up that EBITDA to where a PE firm is very attracted to it?
So PEs are looking at 3 million of EBITDA.
3 million. Okay.
Yeah. Yeah. So, and at that point in today's market, I mean, back then 3 million of EBITDA was 7x. Today it's 10.
Yeah.
So, I mean, there's, but you have to have a system in place, right? You have to show that you've been successful putting those together. So if you're a GP practice that does $1 million, typically the EBITDA on that is 20%. So if you do the math, you need 15 practices.
Yeah. Yeah.
Right? Doing $1 million to be able to get so how do you get to the 15 is really the journey. Now for the dentists, the banks like giving money to dentists. So
it's cash flow. I mean,
yeah. I mean, because dental offices typically don't fail, right? What fails is, does the dentist have the team around them to help them scale?
You're right.
And that's what Mava does today. We help a lot of these group practices scale by utilizing a fractionalized C-suite.
How do you move that person that's just working in the business, the E-Myth, and then move them up, say, here's all what you're doing today and here's your schedule. Guess what? Next week you're doing this, which is completely different. It's above the business.
Yeah. So I mean, what we found is data doesn't lie, right? So we're able to start pulling data, either out of their system for what's happening operationally in the practice, through QuickBooks, and say, hey, look, you know what? Your margins are pretty strong. Your payer mix is strong. You're running a good practice. You're in there alone. You want to grow. Let's get an associate in here. Right now, let's see if you could train that associate to provide the quality of care that you do at the speed that you do, let's say, or the efficiency that you do. And dentistry is a people business, right? You need to make patients happy, and you've got a lot of employees that you have to grow. So it's constantly growing people. The systems are easy, so then we help them put together, hey, look, this is your type of dental practice, your business model. These are your top 8, 9, 10 KPIs that we need to follow. They should be within this range. If they're in this range, just keep the ball rolling.
And your job, I mean, what those KPIs are. This is funny because when I worked on a marketplace, the KPIs for a marketplace are completely different than KPIs from an e-commerce store. I mean, there might be a tiny little overlap, but it's completely different. Knowing what rings the bell, you can fix it.
Exactly. And I mean, even in dental, like if you're an orthodontic practice versus a general dentist, I mean, the KPIs are not even similar. I mean, you got new patients ones, but they're very, very different.
Do you see most people when you reach out to them, they're ready to say, hey, I want to grow faster, make more money, like some kind of life-changing exit, or are they happy working with people-to-people business?
Yeah, a lot of them are happy doing what they're doing.
Yeah.
A lot of them don't even know that this is going on, right? However, it's becoming more and more prevalent. Look, there's 200 institutionally backed dental companies right now.
200. Yeah, I saw the number on the
right, and they're mandated. They're mandated to buy and partner. So it's moving pretty quick. We're working on a DPO now, which is a dental partnership organization in the Northeast of orthodontists, pedodontists, and oral surgeons, because there's a symbiotic relationship amongst the three. They refer to each other. So we're looking to roll that out. We're looking to get our founders on board, which is about 2.5 to 3 million of EBITDA by the end of the year, and which is probably 12 practices or so. And we're looking to scale over the next 5 years to 80 locations.
Did you say 80 or 8?
Yeah, 80.
And do you take how much a piece of it as an advisor do you take of that?
Well, so on this particular one, I'm going to be an investor in the CEO of it,
Oh, okay.
right? So Mava will act as a third party to provide some services where needed if we can't get it elsewhere for a better price. So we'll utilize Mava for fractionalization in the beginning until we can just start hiring our own people internally.
Gotcha. And then you bundle it up and you're already, I mean, you've got 200 now private equity groups seeking what you're putting in front of them.
Yes, exactly. So, we think that this particular model that we're going after, we have the ability to grow at that scale in the Northeast market where we're looking to focus.
Yeah. How long do you stay with them? How long did you, back to the Dynamic Dental partner, how long did you stay with Huron
Yeah, so interestingly enough, I stayed 6 months, but everyone knew that beforehand because I had recently got married and my wife was in Massachusetts. That's where I'm from. And I was living in Florida and she was coming down there for 2 weeks and then we would go away 2 weeks. It just wasn't working. And so, shortly thereafter, I had left them.
Yeah. When they private equity buys, did they purchase 100% of it or was it 67 and ask you to roll over another 20, 30 to continue working on more acquisitions? Because I looked on Huron's portfolio and they acquired more and more, changed the name to Pure.
Yeah. I think they're up to like 70 locations now or so.
Yeah.
75.
That's amazing.
Right. They've gone through a number of iterations, but they've had it for a while. So, in this particular model, I would, in theory, be on for a while if I wanted to, right?
Yeah. What do you do right now to market yourself to get in front of these dental DPOs to say, Vin is the guy we need to talk to if you want to do this?
Yeah, I don't do that great a job of it as a problem. No, you know what? Before I used to, because I was traditionally an operator and in the weeds all day.
Yeah.
It's tough to do it. So then after I came out, I helped some people put on these DSO conferences and I was speaking. So I was more out and about speaking. So people would ask me, so now after COVID, I really haven't been on the circuit.
Yeah.
And, but it's fine because I'm really focused on creating our own, DSO, DPO at the moment.
And are you doing more or less traveling that you used to do?
Yeah, so I'm doing more traveling in this market, visiting doctors and all, right? So we've got a biz dev team that I'm working with to try and, drum up these opportunities.
Yeah.
So we've got like a pipeline of 20, 25 deals right now. Obviously, they're all going close.
So the business team is out there making phone calls, making meetings, and they qualify them, and then you get in front of them with some kind of presentation, right?
Exactly.
Yeah. How long does that presentation last? I mean, does it blow their mind, or do they get it?
Yeah, by the time they're on the call with me, they kind of get it. A lot of them understand what's happening, and there's all different reasons. Some are like tired of it; they want to get out of the chair, and we can potentially create a path for them. Others really get it and say, "Hey, look it, you know what? If I can join on with the right partner, in 10 years I can have that support and I can keep growing practices. I'm going to be better off than trying to do it on my own."
Yeah.
Now, a lot of people don't understand that. Like I didn't understand it when I was younger either. But these opportunities didn't exist when I was younger. Like we were on the forefront back then. We didn't have a lot of opportunities for the new types of models. The new types of models, like I said, the DPO, dental partnership. So we really partner with you, and we're kind of the private equity firm that actually knows dental for them, right? So it's kind of like a DSO within a DSO.
Oh, you said you were an investor when you say partner. Are you actually investing capital, or is it?
Yeah, I'm actually investing capital, but obviously a lot less than the private equity's putting in. I mean, going to be pretty substantial. But what happens is, so let's say you got 3 practices and you're like, Vin, I'm just getting it going here. I got 3 practices, I want to keep growing. And we'll put out a model that says, okay, look, we're going to come in and purchase 60%. You're going to roll 40 in. And now look, we're going to give you all the cash you need to grow. And not just the cash, we're going to give you all the support to allow you to grow. So you don't have to go through all the trials and tribulations that I had to, 2 or 3 times.
Yeah. And that 60% when they sold out, that's their money though. And you still put up other cash to help like working capital or marketing, right?
Exactly.
Okay. Yeah. And are you looking for a specific, or you have targets like, obviously what you're doing here is wash, rinse, repeat. And then you've gotten so good at it, you go, you know exactly what to look for. How do you continually find the people to fill in these roles to where somebody wants out of the chair?
Yeah. So, well, out of the chair is a journey, right? So it's a path that the doctors have to graduate from. And the graduating is the ability for them to mentor other docs to do what they did.
Yeah.
If they can do that, they can get out of the chair. If they can't mentor another doc, then they're going to get stuck.
Yeah. And usually when that, when they're ready to make that transition, does the business already have the cash flow to support the next doc up, or there's plenty of space in there? Yeah.
Oh yeah. Yeah.
Interesting. And you also bring organic type growth ideas that you've seen through these, nearly 100 probably different dental practices that you've worked with. Yeah.
I mean, look, it's like a 1, 2, 3 approach right out of the gate. It's working with them on a budget.
Yeah.
And, working with them on tracking metrics, we'll get a good bounce on year 1, just doing that. Right.
Like what kind of bounce? 20%, 30%, or
yeah, like
12%. Okay.
That's the average that I've seen. The good ones are higher, right? The ones that embrace the relationship.
Yeah.
The others that don't, but that's more on the, those folks probably wouldn't become part of the group, but on my history with consulting side folks, ones, they might hire you, but they may not want to listen to what you say, and there's not going to be a job.
And they don't do it, right? They
don't do it.
They spend money with you, but they don't execute on what you tell them to do. Yeah.
Right.
Yeah.
So then we go into marketing, right? And now we're starting to lift new patients, right? Once we get to new patients, now we can start lifting provider hours, right? In practice hours. Some of them are working 3 days a week because that's all they want to work. And they got business for more. So, and they haven't really wanted to look for another doctor. So now we do it for them and it's not a problem.
So you're maximizing cash flow before you grow. Yeah.
Excuse me? Say that again?
Maximizing cash flow.
Exactly.
Yeah. Yeah.
Right. I mean, a lot of these practices are not, fully utilized, right? They might be at 70% utilization or 60% utilization.
And when somebody says, he goes like, I don't want to do that, you're still going to figure out how to get 100%, even if it's not from them.
Yeah, I mean, we're going to work with them, right? We're going to, we're not going to just jam it in there and say, look, we're doing it anyways.
Yeah.
Because most of the practices that we're partnering with, they have good margins, so they know what they're doing. Right. So again, this is not a turnaround type situation. These are what we're doing for us to scale at the speed that I'm suggesting we would, from 0 to 80 in 5 years. We can't do that with turnaround deals.
Yeah.
We need good practices.
Yeah.
Right.
A profitable practice. Do you take any practices that are, say, break even or I'm losing money? Do you fix those? No, you don't like them?
Yeah. Or no, we fix them, but not in this particular model.
Right.
On the consulting side of business, that's what we do. Right.
Yeah. Now, is this fund that you invest or purchase the businesses, is that from the proceeds of selling out to Huron and other stuff, or do you have a fund where you're raising capital from other accredited investors?
Yeah, no. So right now we're in market in 2 areas. One, bringing our founders together, and 2, where I'm in the midst of speaking to institutional investors at the moment that want to fund the deal,
Yeah.
right? Because it's 70 million or so that's got to be funded between debt and equity over the course of 5 years.
Interesting. Yeah. How much debt and equity? What's the split when you purchase a company?
Yeah, I mean, it's all on what the doctor's going to roll and how big your EBITDA is, because then you can leverage, the bank multiple of leverage higher.
It's cheaper
Right,
than the
so
cash. Yeah.
exactly. So I mean, out of the gate, it's more equity when you're starting from ground up like we are. Out of the gate, it's more equity until you get to the 3 million of EBITDA, and then you can get better debt,
Yeah.
right? Maybe at 4x. So typically you're seeing anywhere between 3 and 4x of leverage, up to 3 of EBITDA, over 5 of EBITDA. It's 4.5, 5. It depends. It depends if that's senior. But if you're doing mezz where it's interest only, it could be 6, and it still works because it's only interest in some type of a PIK at the end of the year.
Yeah. And what's the goal for this new project? You raising the 70 million, making the acquisitions and doing the roll up, and then selling to another one of these 200 private equity companies? Are you looking for a specific number in the exit, or?
Yeah. So the exit would go either to another private equity firm that wants to continue the story because we have traction and we still got a big pipeline to fill.
Yeah.
Or we sell to a strategic, which is basically someone else doing the same thing we are. That's private equity backed.
Right.
Right. And the theory is that at 20 million of EBITDA, we can get 15x.
Yeah. And that's a big payday for everybody. You and who all the smaller
Doctors,
operations.
everybody.
Yeah.
Everyone.
Yeah. That's it. That's the arbitrage everybody goes for. It's like if somebody was just starting out in your business, wanting to acquire, where's the best place to start out? Say, find that first practice that's doing this, this, and this, and buy them with debt or equity, whatever you got, and then wash, rinse, repeat. Maximize cash flow, wash, rinse, repeat.
Yeah. So I mean, look, we're a DSO, right? So we don't own the practice. So if you're a non-dentist, you have to have a dentist partner, or you can't own a practice because the dentist owns the patient base. The DSO would own the non-clinical assets of the organization.
Yeah.
Right. And charge a fee to provide their services.
Yeah.
Right. So that I don't want to create the confusion around there.
No, I get that.
However,
that
in
makes
Arizona,
100% sense. It's the same way in the medical with HIPAA and everything. Yes.
Right. However, in Arizona, a non-dentist can own a dental office.
Oh, is that right?
Yeah. There's a few states.
Yeah, I think they just passed that in Arizona for attorneys too. They can own.
Oh, really?
You don't have to be an attorney. Yeah.
Wow. Interesting.
Yeah, I had a conversation a while back on that.
That's interesting. That's real interesting.
Yeah. So where do you go to continually get better at skills doing what you do now? I mean,
I read a lot. I go to different other conferences or masterminds, if you would, just to get out of the dental thing to see, how I can bring what successful people are doing in the outside world into dental.
Yeah. Yeah. What kind of masterminds are we talking?
I do. I've done the Joe Polish stuff. I've done Peter Diamantis 360, which I still go to those. I don't go to Joe anymore, but I will at some point in the future. Strategic coach, right? He's been great. Dan Sullivan.
Yeah. Yeah, these are all things, Joe Polish. I'm very familiar with each one of those guys.
Yeah.
That's great. And Look, I love the time. There's a picture of a kid. Is that your grandkid on the Gmail?
No, it's my son.
It's your son. How old is he? Yeah.
He's 8 now, but yeah, I'm started late.
Yeah, No, you're not starting late. I'm 60 and I got 14-year-old. So
All right.
yeah, I don't know if that was a good decision or bad decision. This just is what it is, right?
I agree with the comment.
Well, Vin, man, I really appreciate the time talking with me about your current roll up and your current advisement business and working with everything. I want to thank you so much for that, man.
Yeah, I mean, thanks for having me. This has been fun.
Good deal, Vin. Thank you
Great.
so much. All
Yeah,
right.
thanks.
Cheers.
Appreciate it.